was one of the most fascinating things I think about this market, considering all of the technology and all the strides and all that kind of stuff. And we've talked about this before, but it's not just our opinion. I think this market has gotten increasingly inefficient and increasingly dumb and increasingly nonsensical.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am joined, as always, by the Brain Trust himself, Mr. Chase Taylor. Starting off here a little early. We're about 4 minutes from the close here. Why don't we start off with a rundown of the indexes, and obviously we've got plenty to discuss from there. But let's hear what Chase has to say about that.
So S&P. Here with 3 minutes to go, up 0.41. Same for the Qs. Small caps up 0.93. Equal weight up 0.13. Mag 7 up 0.32. So small caps the big winner in America. The dollar down 0.2, but despite that, all world ex-US actually down a little bit. So interesting to see S&P beating the rest of the world on a dollar down day. Bitcoin up about 1%, back above 111. Gold up 0.6. Gold miners up another 2%. Silver down about 0.2. Copper flat. Front end yields down 4 basis points. 10-year down 2, but 30-year still up 1 basis point on the day. And as you would expect, vol down a little bit. You're on front month futures now. You're down below 17 on vol. Don't necessarily expect that to change until we get more important data in the future, though. And then as we enter the close, we got NVIDIA up 1% on NVIDIA earnings day.
Yeah. The topic that we talked about the most today on our investment meeting was rates. Man, I have so many different thoughts about rates. It's hard for me to look at rates right now. Our buddy Cuppy thinks it's signaling, serious underlying economic weakness. I feel like based on data we've seen, I would have been a little more sympathetic to that view a month and a half ago, 2 months ago.
Yeah, well said. Yeah.
And kind of give us a little summary of that data, but
yep.
It looked like we were seeing some serious softness a month and a half ago, and this latest round of data is kind of pointing in the opposite direction. What stuck out to you with that?
Yep. So if you look at, as kind of a proxy for data versus expectations, the economic surprise index, that went from bad to good. It's actually going pretty well right now, suggesting the data is better than expectations. I mean, we've seen that kind of almost across the board. We have this framework of financial conditions leading the market. So it makes sense that you had like a 20% drawdown on equities in April. Well, then May and June data would be soft, and it was and that revised data on jobs especially shows like a sketchy labor market in May, June. But then what people ignored in the fear of that jobs report was like that the July data was, it was at like a 3-month high. Like maybe you're coming out of that. And that shows on ADP data, so not just non-farm payrolls. But then if you look at things like Redbook retail sales, which is like a same store sales private data set, not a government data release, you're growing fine on retail sales, and that's same store, so it's a comp thing. And then if you want to look at the labor market, one of the best ways to do that, and kind of in real time with no fluff, is to look at the money coming out of people's paychecks going to the treasury, right? Those tax receipts. And that's fine. So that's growing at like a healthy pace, suggesting that labor market not falling apart as we speak. And we can see that too in the jobless claims. Like they ticked up a little last week, but you're below the post-COVID average. You're below where you were in 2 years ago, and that economy was rip roaring, and you have even less now than then. So like, there's a lot of data that suggests you're fine. A lot of the consumer confidence stuff has gotten a lot better. So what in hard data has been the case for the last 5 years is outperforming the soft data. So that suggests that you're fine now. Cuppy's view is kind of like a lot of earnings based stuff. He listens to a lot of earnings calls, and he traffics heavily in a lot of like small blue collar industrial manufacturing stuff, and they're all screaming like big problems. And I think that's true. I think that's legit. I think we will feel that in the economy. I think it's just like probably months or quarters away for that stuff to come through. And I think it's a lot of what I've been talking about a ton with, like, you know, the tariff like wrench getting thrown in becomes an issue eventually, where people have to raise prices and like all their input costs go up, and like that squeezes them and they have to let people go. So I think all that will play out, but probably more like next year. And again, go back to the financial conditions framework of, okay, well, now we're back at all-time highs on stocks. Credit spreads are incredibly tight. They're not signaling any problems.
Yeah, but
all that stuff suggests like you're back to being fine in the economy.
Right.
Not great. You're growing more like 1 than 3, but you're fine.
Yeah, but credit spreads have been pointless for a long time.
But they did blow out in April, to be fair.
They did. Yeah. I mean,
But you're right.
blowout's a strong term, but yeah, I mean, that goes right into my issue with this overall market, meaning it does not price things in like it used to. It does not price things in gradually. It's like a blind drunk that stumbles into stuff. And you'll just see, you know, credit spreads used to be kind of a gradual deteriorating kind of thing. You kept your eye on, you're like, oh,
yeah. Now you got private credit for that. So
yeah, I would expect credit spreads to be historically tight till they're not. Just boom, you know, just all of a sudden.
Totally.
Because it was one of the most fascinating things I think about this market, considering all of the technology and all the strides and all that kind of stuff. And we've talked about this before, but it's not just our opinion. I think this market has gotten increasingly inefficient and increasingly dumb, and increasingly nonsensical. But that being said, you know, the other thing I don't think people think about is the fiscal role. And we talked about this a lot, but there's a part about it that I think is getting kind of lost in translation, and people are kind of losing it because they're not thinking about numbers. Remember, when you've got deficits that are running 7% of GDP in an economy where historically the average is like more like 1.5 to 2.5%, any spending increase you get by government, by definition, is going to be 2.5 to 3 times more impactful than it was in the past, because you're starting from such a higher place, right? So if government spending increases by 7%, let's say from one year to the next, all 7% aren't created equal, right? It's a 7% increase while you're already running 7% deficits. And when you think about the way we look at GDP and how GDP is tabulated, and then you look at how many other governments around the world are doing something similar, I don't know that it's possible that I don't want to use the word anything's possible, but when you look at the way that whole setup is put together, and you take into consideration these numbers and the percentages, it's really fascinating, because it's not. I think that you got to look at things and always keep a historical context in mind. But at the same time, I think you got to look at this market and go, a lot of the historical comps are just completely useless. You know, because you'll throw out a term like, you know, for instance, like I was just saying, a government increased spending by 5%, right? That means something different today than it meant 25 years ago.
Right.
Right. The magnitude of that is just substantially different, just looking at where we're coming from. You know, when government increases spending and you're 65% debt to GDP, it's a lot different than if they increase spending by 5% when you're 120% debt to GDP, right? And so, and then, you know, the other side of it too is, I would be surprised to see retail sales plummet in an environment like this, where the stock market's up 9 to 10% on the year. And why? The largest / richest generation in the country is every single day, we've said this, but every single day becoming more reliant on investment assets to finance their lifestyle. And if that portfolio is up 10% today, that's not, or 10% on the year, and it isn't going to be a constraint to their spending. And this goes back to that whole thing. I'm convinced that a proper recession, the way that we think about them, is almost impossible unless you have a serious equity sell-off.
Right. I don't think there's no two ways about it. Like,
Yeah.
Unless you get, it's just too big of a piece of the economy now, and too big a piece of portfolios, and that combination makes financial conditions the most important, is economic cycle indicator that there is. I mean, we can look at, manufacturing inventories until we're blue in the face. Like, this isn't gonna matter. But if you have a 30% drawdown and it stays that way for 6 months, spending patterns will absolutely change. And we're a very consumption-driven economy, so if spending patterns change that much, you have a problem. I think that's very clear. And now you can have an industrial recession that leads to, a market problem that leads to a proper economic recession. But, you have to have the market down. To me, COVID proved this, right? You can do anything to the economy as long as you keep markets up, you're going to be okay. At the way we're structured today, anyway.
Agreed. And look, and this is one of the tough parts about where we're currently at, because I think that you have to like really separate market prognostication from from drawing too big a. But my point is this: I'm not doing a very good job making it right now. You just got to be very, very careful with how you're interpreting data and how you're looking at things, because, for instance, things are not driven by traditional economic forces anymore. We know this, right? So it was one of the things we were talking about on our meeting today about the 30-year Treasury. Its lack of movement higher is puzzling to me, especially when Powell's talking about cutting rates. At the same time, in a way, it's not. Meaning, I think that central banks, when they've told us this, they've been cooperating for a long time. I think they all have some variation of the same gun against their forehead, right? And so for now, I think they're going to be, my guess is they're going to be cooperative. They're going to kind of jump in and help hold each other's yields down on the back end. And so there's this thought, like, economically, do we think we'll be in a position where we will see 0% interest rates going forward? Economically speaking, I would say I would doubt that. Doesn't mean you won't see them, though.
But politically speaking, it's a different story,
right? Totally different story.
And I think, and that was the point Cuppy was trying to make, because the way he phrased it was Trump's gone full Erdogan, Turkey's president, and yet back-end yields aren't going higher. So that was why he inferred, economic weakness is what explains that. What I think explains it, when I talked about it in our investment meeting today, is I sit here and talk about how these policies, whether it be the tariff policy or the let's smoke enough FOMC voting members to get skew the board to where we can cut rates a big time. Like, yes, you can see all that taking shape, but the market doesn't think there's going to be inflation. So none of that stuff matters. To your point, like, the market will sleepwalk drunk into everything. I think this is just another case where, like, you have these policy fireworks going off, political fireworks going off, and it makes it so clear, like, that we're heading to a more inflationary environment than we're in today, and a vastly higher inflationary environment than we got used to in the last 20 years, ex-COVID, right? Mm-hmm. And the market just doesn't believe that yet. So the market's going to have to get beat over the head
I don't think
with high realized inflation.
And I don't think the culture believes it either. I think everybody, there's this built in, people say something different than what their behaviors show, right? What this market is showing me and what investors are showing me, as opposed to telling me, is that they think 0% interest rates is homeostasis, right? That's the way it's acting, right? Like, we're headed back there.
Yeah. And like 2% inflation is like was handed to us by Moses or something.
Right. And you look at them and go, guys, look, that is really stupid. Okay, because 0% has never been homeostasis in any economy, anywhere. It's nonsense. And they'd go, well, what about Japan? I'm like, yeah, go look at how Japan performed over the last 38 years, right? It wasn't, I mean, them being at 0% wasn't so much policy as it was a disaster,
Yeah, I mean,
right? Like, that's not a good thing.
they've done much better since they've had to raise rates a little bit here and their inflation's picked up.
Yeah, which I think, honestly, and I know you'll agree with this to some degree, but you got to question everything that we know about economics or everything we think we know, because we've got some real life examples like us, like Japan, that are really challenging a lot of economic dogma.
That to me, that's what the 2020s have been all about, is turning a lot of economic dogma up on its head, and we keep unmasking the economic profession and academic economics for like the mistakes they make, and especially in the models that they have. Like, there's a lot of things they just don't put in there, right? And I saw this yesterday with John Williams from the Fed saying basically that it looks like the neutral rate hasn't even gone higher since COVID, and like the only way you could even reach that conclusion is to not think about fiscal spending, right? Which in his model, I don't think it plays any role whatsoever. So he's just looking at like productivity and stuff like that.
He's looking at the economy through a pinhole.
Come on, man. Like,
he's looking at it through a pinhole.
Just wipe your eyes and look out the window, and it's pretty obvious. Like, I mean, rates are 4.5 right now, and unemployment is 4.2, and inflation's 3. Like, obviously, the neutral rate is not low.
There's another side to this that has always been just exhaustively annoying to me, is the complete pushing aside and ignoring of the behavioral side of the whole thing, right? The human behavior and all that kind of stuff. You cannot. So for instance, when you're looking at a world and you're like, okay, interest rates going up or down mean this, but we're going to completely change the role of a central bank in an economy, and we're going to change the way people think about central banks, and we're going to make people, through 15 years of practice, right, and regiment, we're going to make them believe that it is our job to make extinct any bad economic outcome. I know for a fact there's just like, if you're using the same tools and addressing problems the same way you were in terms of monetary policy, if you're a central banker, if you're addressing them the same way you were 25 years ago, I think that in and of itself is an error, because so many of the underlying conditions are so different. So many of the imbalances are so much more imbalanced. And if you look at the role that central banks have played in the economy, it's decidedly different and decidedly more proactive than it was prior to 20 years ago, right? So that's going to change the way people react to data. For instance, you've got a feedback loop, again, because of the time coming out of 0809, where, and I don't think this is still dead, where bad economic news equals good market reactions. That didn't used to be the case, right? Like, it's funny how we change. It used to be, you got bad economic news, it was just bad economic news. There wasn't anything good about it, right? Stocks didn't like it. But that's because people were not used to the Federal Reserve having, there used to be this kind of good cop, bad cop thing, right? With central banks, right? Like this whole, we're going to do what's right for the economy, and if that crushes your stock portfolio, then so be it. That's just not the way they are today. It's not. And you hear them talk about it. And I'm not saying I think it's idiocy, but I'm not even making a judgment on it. I'm just making an observation, right? It's just decidedly different, the role that they play. And I think when you're not taking that into consideration, which monetarists are clearly not doing, right? They're looking at the world as if nothing has changed. And I think that's where a lot of the confusion lies. You know what I mean? Like, markets are a delicate thing. One of the things that makes them function is the fear of loss. Well, when you change your role in that market and you change people's perception of what is at risk,
exactly,
you can't underestimate the feedback loops and the other things that creates.
Yeah. So a perfect example of that is from Russell Napier's book on the Asian financial crisis. And this is something that I think a lot of people know a little bit about the Asian financial crisis, but not this nugget. And that is, we had the tequila crisis in Mexico. And basically, a lot of American investors and a lot of just global investors, but really American portfolio managers, investors, put a bunch of money into risky but very high yielding, nice carry trade bonds in Mexico. Well, they were going to go belly up. Like these things in size were going to default. It's going to blow up some financiers in America. Well, the U.S. and IMF come in on the white horse, throw a bag of money at Mexico, bail it out. That allows all those portfolio managers to stay whole. That sounds like a Mexico story, maybe a Mexico-U.S. story, but
it was a blueprint
for global emerging market investors. They saw that and they went, "Oh, my Indonesian bonds that I have a nice sweet carry on too, or my Thai bonds, they'll just ride to the rescue. So my left tail is smaller than I thought. Let's get aggressive." So the flows come in, right? Like even more, and it creates its own reality.
Well, and it becomes a self-perpetuating feedback loop, right? Because the market isn't recognizing the danger, because it believes the central bank is going to anesthetize it. If the central bank doesn't, it creates twice as big a problem as it would have before, right? Because the market isn't pricing those things in. Whereas before, when you saw something like the Thai baht implode, undoubtedly there were market participants that saw that coming, and some of the steam was coming out of it along the way. But this is that problem that you and I have talked about, of this market just stumbling blindly into things, because rate of change, like you and I have talked about, the delta and how much something changes isn't nearly as important as the rate of change. And really shocking, that's the thing that scares me the most. And I don't see anything imminently, but the thing that scares me the most about this stock market is not just based on valuation alone, but all of the assumptions that have been built into that. I don't know I've ever looked at a market that had more assumptions built into it, that people were more like 100% confident in, right?
Yeah.
Like I was reading this funny tweet the other day about this guy that's clearly relatively new to investing. And I mean, as in like the last 10 years, like he wasn't seem like a neophyte. He didn't seem dumb. But it was basically like, look, there's just a really way to outperform the stock market. And you just buy these really good performing companies. And when they go down, you just buy more. And it's really simple. Look at my results. You're like, but that's called a bull market, dude. Right? That's a bull market.
Welcome.
Yeah. Have fun. Enjoy it while it lasts, right?
Yeah, because
this too will end. Right. And so what I'm saying is that there's no, and it drives me insane, because to ignore it, which central banks and central bankers and economists do all the time, it's just idiocy. It makes, of course, the perception of the probability or the possibility of loss versus gain has a lot to do with the performance of financial assets. And just to think that you can tinker over here and not have any downturn or down the road impacts is tough. The other tough thing about it is, when inflation is the risk, my assumption is that I would expect both valuations and these markets to continue to get more obscene. I see it happening, right? And the toughest part about that is that could last for an extraordinarily long time. And you may have to play into that obscenity to protect yourself from inflation. That it just sets up a really nasty air pocket where, when the veneer finally comes off and when something changes that causes the rubber to meet the road, you're just so far removed. And I think you're pretty far removed now, but you're so far removed from intrinsic value, or even people talking about intrinsic value. I was reading this interesting, another social media deal, where it was this crypto guy, again, seemed like a pretty well-informed Bitcoin enthusiast. And he was putting up a text thread between he and his brother. And his brother works in an investment bank, has an MBA for an Ivy League school, and is like anti-crypto. He's like, oh, it's no intrinsic value, all this kind of stuff. And we've heard these things for a long time, but to see it written and to see somebody have the confidence to write these words just kind of blew me away. And he was saying, how could my brother not see the value of the community involved here, and how it's given people purpose, and how it's doing all. And I'm sitting there going, yes, you just described an asset bubble, dude. That's what that is, right? The community, it's because you guys have made money. Okay. The purpose, because you've made money. That's all you've literally described every aspect, every behavioral part of bubbles and why they pop up amongst human beings. You know what I mean? Because you're valuing assets on something completely removed from the intrinsic value of that asset. And I just think and here's the problem. It's an issue, it's a disease, it's a cancer that's only going to be diagnosed and seen in a postmortem. Do you know what I'm saying? Only then will people go, oh, you know what? Maybe that did have some deleterious impacts on risk appetites for investors. And maybe that got out of control. And it just, the other thing is that, and I might be placing, and I'm probably placing too much blame on central bankers, but there's also the passive craze, which is fed directly into that as well. You know what I mean? Because
not to mention the international capital flows.
Yeah. And so all of these things are by definition temporary. And you just, it scares you how tight that rubber band gets stretched.
Yeah.
And, even now looking at the way the rich valuation that US markets are trading at with these interest rates, and it's just, there's just a lot of air there.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Speaking of the capital flows and kind of where we're at, interestingly, and this shows you kind of how easy it is to get duped by some of this stuff. I don't think the average person realizes that in euro terms, the U.S. stock market is down 3% this year.
Yeah.
Down.
Right.
And in dollar terms, the European market's up about 25%. So that currency part is playing a huge role. And we know all these big pension funds and everything in Europe are finally going to get around to having their meetings to talk about asset allocation after this summer. And to go back to Cuppy's Erdogan thing, like we see the, full scale attack on the Fed right now from the executive branch. And I think a lot of people are like, how does the market not care about that? Like, where's bonds? Like, why is the dollar not down even more? Well, one of the things that can precipitate that is big money people that run billions, trillions of dollars to go, I want less exposure to that now. Thank you.
Well, and here's the thing, honestly, between the months of September and October, I don't see anything that makes me extraordinarily worried about the economy. Not yet anyway. The thing that scares me is obviously you've got bad seasonality, but also what you and I know in the industry, which is I think it is entirely possible to see another 10 to 15% pullback here in US equities over the next 30 to 60 days, just because so many of those things that you rightly point out, so many of those things are going to get pushed off during the winter months and then get revisited, the summer months,
right,
and get revisited in September and October.
It's at least a head on the swivel kind of a thing. And all the tick data shows like the rest of the world has been buying US stocks and bonds, no problem this year. Stocks hand over fist lately. But, if some of these big money people decide to go from overweight to equal weight or overweight to underweight on US equity, US assets, broadly speaking, that's something you would feel.
And I think you're going to feel it. And the reason I think you're going to feel it is just, I'd point to the dollar. Okay. So you can think that US markets have gotten too expensive. You know what gets international PM's attention? The dollar.
And that's been the release valve so far this year.
Yep.
Like our bond yields up huge. No, now they're not low. If you closed here in the 30-year, that's a multi-decade high, but it's not ripping higher either. But, the dollar, like I said, we're down in euro terms. That tells you, the US market's up like 10%, but it's down in euro terms. Like, okay, well, the dollar's really hurt here.
And that's why, and that's one of the things I keep going back to, which is I think if you're an international PM, I bet you, like, if you took a survey, I would be shocked if the number was not somewhere in the 80 to 90th percentile of international PMs that to some degree have materially decreased their exposure to US equities and are deploying those assets overseas. And the reason I say that, again, the dollar.
The scary thing is the tick data suggests they haven't really done it yet.
Right. Right.
So if that stuff's in our future,
well, that's that was kind of
they hedged the dollar.
That was kind of my point. If I was expecting to see that this year, I would expect to see it the most in September, October, and Q4 toward the end of the year.
Right.
Especially with the outperformance of international on the year and how big that outperformance was. The dollar dropping. Are flows into the U.S. going to stop? No, but it's one of those things. I just think people screw up the numbers when you're so bloated like we are in terms of valuation as it relates to the rest of the world. Just a little, not a flip, not even negative flows to the U.S. would be required to do this. Just less flows.
Yeah,
when you understand,
it would make a huge difference.
Could drop index values substantially.
Right, and then that exposure to domestic stuff gets acute. Like it goes from, okay, you can, right now, can we withstand going from 4.2 unemployment to 4.5 without like seeing it in the equities? Sure, but if you lose international inflows, or heaven forbid you go negative on that, can you withstand more people losing 401ks? You cannot.
No.
Then it becomes a double-barreled.
Not at the level
problem.
you currently are. Right. Just because I think that where we're at is sort of one of those places where, like, how do you get there? All things have to be optimal. Right. Like in terms of optimal as far as the things needed to push price higher. Right. When you get to that level, you don't need all of them to go away for that to reverse. You need one to go away. Yeah. Right. And then that will precipitate some more.
They kind of make each other move. So you can't get international outflows without having economic problems that lead to 401k flow problems, and vice versa.
Yeah. Or just the year, right? Another thing that will cause international outflows is if we finish this year with international markets substantially outperforming US.
Right.
Right. Then clients sit there and go, are we getting any exposure? Just because they're like, they're going to look around that,
Yeah. The guy on CNBC said EMs are good.
Yeah. Right. Or even look at a portfolio like us. Wait a second. Market was up 10%. You guys were up 22% last year, or whatever it is that we're up now. How did you do that? Well, mostly exposure to international and precious metals. And they're like,
that's it. Yep.
We probably should have some more exposure to that. Right. And it's just that little bit of a thing when you're this extended, when you're 70% of global market cap, and you're 22% of global GDP, you don't need a lot to get that number back down to 50, And like I said, it's not so much, when we've said this a million times, it's not running from US equities. It's just saying if US goes back to 50, that means the rest of the world effectively doubles. Right?
Right. And we've gotten to the point where
on balance.
The last interview Dimitri did on Hidden Forces, the guy talked about, like, not only is this stuff true, but like these economies need the capital more and are likely to be more productive with it than we are, right? The average small industrial company in India was probably going to do more with $100 million than the average whatever that gets $100 million in the US, right?
100%.
So it even makes sense sort of from like a pure fundamental standpoint.
Yeah, it really does. I mean, again, and I'll just say this, over the next 12 to 18 months, our take could certainly be wrong. That being said, if you are not increasing your exposure to these other things right now, you're not a responsible person. You may end up being right.
Sure.
But if you're not increasing your exposure to non-US assets and stuff like that, type of behavior will get you run over eventually, even if this doesn't end up being the time. I mean, just on all levels, the things we're talking about. And to me, the big one is the dollar, right? Yeah. Trying to pick the top and valuation. But I don't think that US investors especially understand, most US investors, you ask them where the DXY is, they don't even know what you're talking about. International investors all know what you're talking about.
Right. And that we're down in euro terms and up in dollar terms tells you everything. And it's easy to forget, sitting in America and thinking in dollar terms of everything, that half the equation for them is the currency. So and for the last decade, they didn't have to care about it because both went up.
Yep.
Well, now only one's going up, so they have to care. And if both go down, then they have to run for the hills. So that dynamic, and to be fair to we as US based, we talked about the new investor. It's like, that's just a bull market guy. Well, all of us, even if you've been doing this for 15 years, probably 20 years, you haven't had to think about dollar down in a meaningful sense. And obviously the dollar hasn't collapsed or anything. It's not like it's low. But to go back to the, central bank losing independence stuff and some of the stuff we're talking about, you may get into a not a cute dollar down phase, but dollar's going down a % a month, every month kind of thing.
Yeah, I mean, in the last 2 years, the dollar topped out at 116 DXY.
Yeah, 115-ish,
Yeah. Now you're at 97 and change. I mean, I don't know. I'd have to go back and look at it. But as long as I've been in this job professionally, I don't know that I've ever. So I've been doing this job professionally now for 17 years. I don't think that I've ever operated in an environment where over the course of 24 months, the dollar had pulled back 15%.
I mean, it was the worst first half in 50 years.
Yeah, there you go.
So
there you go. Yeah, so
Yeah.
so you got people navigating this environment that they've literally never been in.
And I've been arguing for like a counter-cyclical rally in the dollar because my view was tariffs are inflationary. The Fed will have to react to that. That will help the dollar go up. But we got maybe a window into the Fed's not going to react to that. They're going to be like, it's just tariffs. It's transitory. If that's the case and you're pushing 4% inflation and the Fed's just like, yeah, we're going to cut anyway because whatever, like that'll go away eventually. It's just tariffs. Then you get in that situation where the dollar it can't latch on to, oh, well, America's rates are higher because they have that inflation. It's just going to go, oh, America doesn't care about inflation. Then the dollar just lets go that much more.
Yeah.
So we'll see.
Well, that does it for me, my friend. Are you good on the day?
Indeed.
All right. We'll be back. Got to discuss NVIDIA earnings. Have they come out yet?
I don't know.
Well, anyway, we will discuss it tomorrow in
That's
full. So you guys have a wonderful evening, and thank you for joining us as well, or as always. Join us on social media. You can find us on YouTube. Just Google and search Know Your Risk Podcast. Easy to find. Got some great stuff, some great content and interviews coming up over the next 2 weeks that you're not going to want to miss. Anyway, we'll see you tomorrow. We'll be back. As always, you're listening to
By the way, those are Wednesday. I don't know what I was smoking thinking that they're today.
Oh, they're
I think
tomorrow.
I saw a bunch of jibber jabber on Twitter.
Yeah, I thought it was today too. Anyway. All righty. Well, we'll see you tomorrow on NVIDIA earnings day, and we'll keep you posted. We'll let you know how it goes then. Anyway, have a great evening. We'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.